Welcome to Friday Takeaway. This week, we take a look at major banking developments and possible barriers for Karex. But first, apparently POTUS Trump had a very covfefe week. Trump had tweeted that word on Wednesday, which drove the internet bonkers and made people worry that the president is tweeting nonsense. Less amusing is Trump's decision to pull the US out of the Paris climate deal. This caused two of his advisors, Elon Musk and Disney Bob Iger, to quit business advisory councils. It also prompted the first and only tweet from Goldman Sachs CEO condemning it. While some could argue that he could do more damage inside the agreement than outside it. So maybe a blessing in disguise? Another thing to keep an eye on is the US jobs report later today. The expectation is that 180,000 positions will be added, which will boost the case for a rate hike. It was also good news at the EPF with investment income in the first quarter spiking 74% to 11.79 billion due to improved market conditions. Not a good week for the KLCI. It traded 0.03% lower at 1771.63 points week on week. Compared to yesterday, it was up 0.48%. JF APAC says FBM KLCI is expected to remain lackluster with support of 1755 points this week, weighed down by the negative performance in the US. Next up, we're going to look at a couple of companies that make the news this week. Karex is the largest condom manufacturer in the world, producing 4 billion condoms per annum. It has 3 manufacturing facilities located in Johor, Port Klang, Selangor and Hat Yai in Thailand. Its own brands are Karex and Inno, which are mainly exported to the Middle Eastern countries. First, the positive, Karex announced that there had been a growth of orders from the African market, while a stronger US dollar would help mitigate the impact of rising raw material prices. It is also seeking a push into the UK and US consumer market with more efforts in expanding into the OBM segment. Now, even though the company sold more condoms, its net profit dropped 28.3% in the third quarter because of higher distribution costs. Price competition is unlikely to let up, and group's profit margins are also likely to remain under pressure with weak average selling prices. Its effort to venture into OBM segment would also increase its distribution and admin expenses. Its shares were battered down after the weak third quarter results, dropping 19.2% to trade at RM1.72 this morning from RM2.23 on May 25th. Overall, analysts are pretty neutral on the stock with 6 neutrals, 1 sell and 1 buy, with TP ranging from RM1.70 to RM2.40. The hottest news in the market this week is a potential merger between AMMB Holdings and RHB Bank. RHB Bank is the 4th largest bank in Malaysia. As for AMMB, it is the 6th largest bank in Malaysia in terms of assets with core segments such as retail banking, wholesale banking, Islamic banking and insurance. The two banks recently got Bank NEGARA'S blessing to begin merger talks. If successful, it would create the 4th largest bank in terms of assets worth about RM365.88 billion. AMMB is strong in its insurance, with RHB more well regarded in investment banking. The clear winner here is EPF, as it is holding 40.7% stake in RHB and 9.95% stake in AMMB. There is always a chance it would not go through, as details have yet to emerge. And if it were not to go through, then the banks would have to then think of how to gain market share. The share prices of both AMMB and RHB have been on the rise since the start of the year. AMMB has gained about 21% year to date. At 10:30 this morning, it was traded at RM5.22, while RHB has increased 12.3% and was trading at RM5.29 this morning. As details have yet to surface, Kenanga Research says it is maintaining neutral at present on both.